Hello and welcome to another episode of the Investing with IBD podcast. It's Justin Nielsen here, your host, and we are coming to you on January 28th, 2026. Although, I'll be honest with you, we actually had to do a pre-taping this time around. We taped on January 23rd because, with any luck, I am in Florence, Italy with my daughter and my wife, dropping her off for a semester abroad program. So hopefully I'm seeing some Medici chapels and the Duomo at this point. But we've got a great show for you. We've got George Tkaczuk coming back on the show. He is a portfolio manager over at RCM Wealth Advisors, and there's a lot to say about George. But let me bring him on and welcome him back to the show. How you doing, George?
I'm doing great, Justin. Thank you for having me. How you doing?
Just fine. And I think the first time that we had you on, you had just won the U.S. Investing Championship. I think, was it in the $1 million plus category that year?
Yeah, it's the $1 million plus. It's they call it the money manager
The money
division. So
manager,
pretty
right?
much
Yeah.
put
Yeah.
my program where I'm
Yeah.
where I'm running.
And
Put
and
that in.
so since I had you on that first time, after you won the U.S. Investing Championship in 2020 with a spectacular, uh, you know, triple digit plus return, you have gone on. So for the last 5 years, you have gotten some really great returns on the leaderboard of the U.S. Investing Championship. You had a great return in 2024 and 2025, both of which you had triple digit gains, but it was a little bit tricky at the end of the years. You still came in very solid, 87% for the last year and 97% for 2024. But I want to talk to you a little bit about the consistency with which you're able to post these spectacular returns on the U.S. Investing Championship. If you wouldn't mind, what is your secret?
I just and thank you. Um, well, there's a few things that need to be done, and I'm going to start. The number one thing is, and we all hear it over and over again, but it's all about cutting your losses quickly.
Yeah.
It's not so much about finding the hot stocks. Everybody knows who the hot stocks are. You open up a paper, Investors Business Daily, and you go through any of their lists and all that, and that's going to show you your best stocks. And you just got to play them right. And at times when you enter them, they might not be right. So you need to be able to cut your losses and cut them quickly. And then you have money to keep playing at and stay in the game. That would be my number one thing. I got a list of things we can go through. I don't know how long you want me to start going on here, but that would be the number one thing.
Uh-huh. Well, and that's a big one. So I guess there's two parts to that. There are, some in the camp that are more position traders, and so they give their positions a little bit of room to breathe, recognizing, especially after you have some cushion, that you might be looking at maybe 10, 4, 10, 15, 20% drawdowns from the top. And then there are those that are a little bit quicker, that maybe are compounding a lot of small gains, more of a swing trading style. So where would you say that you fit in?
I fit in more in the position trader.
Hmm.
And I'll say, so with that comes patience. And there's two types of patience. Patience to wait for your setup, say for your pitch, to
Yep.
buy the stock properly. That's one type of patience. And the other patience are when you do hit on a leader, is to sit and let that cushion develop. And,
Hmm.
and that could be the hardest because everyone's saying, oh, you got a 10% gain, you're silly if you don't take the gain, take it off the table. But I disagree. And I think once you get on the leader, you need to be patient, let that cushion develop, and then on the slight pullbacks, let that position build up. Because one of the other things you need too is just not only that kind of uh, build up the cushion, let things ride, but then you need to build up the positions because you really need to have the concentrated positions to get those returns. Because a lot of times, it happens to all of us. You get a 2, 3, 5% position, it doubles, and you're like, didn't
Yeah.
really do too much for me.
It didn't move it didn't move the needle. I got a double and it didn't do anything for me. Well, you kind of talked about how it's easy to find the leaders, that everyone can kind of see those by scanning Investors Business Daily. But sometimes that's harder to do at the beginning of a rally. So what kind of helps you identify leaders?
The most, I think, the most important thing, and we can even go to an example if you want, but it's relative strength, and that relative strength could be stocks moving to new highs, or there's another way, there's relative strength off the bottom. I mean, that, especially if you got a market downturn, is the most important thing. I don't know if you recall, there was, we had all those IBD seminars with Bill and Neil, the founder of Investors Business Daily, and it was in April of 2009. Uh, we went out to California, had a meeting, and then Bill was buying Apple when it was at the bottom, and everyone thought, like, my God, what is he doing? But the clue there was Apple's relative strength line was moving to new highs, even though it was half the price of what it was. It was off from 200. It was down in March. It was down at about 100, but its relative strength line was actually screaming higher. And that to me was the most important thing. Yeah, if you look right there, you start looking a little bit past the March bottom, April, the relative strength line's at a new high, even though Apple is half the price what it was close to a year ago.
Yeah. And I remember Bill walking me through this trade. One of the things that was kind of additionally important here is that as the market, the S&P 500 index line, was making new lows here, Apple was holding. Apple was holding above its previous lows. And so that was a factor of kind of that relative strength that you're talking about. So not
Yeah,
just the line, but also where the position was.
yeah, and that stuck in my mind forever, because and it took a little while after I went home after the seminar. Yeah, for some reason I didn't quite comprehend it while I was there at the seminar, and I said that's really an important thing. And the same thing happened when we had the COVID bottom in 2020. There were stocks that were blasting to new highs, and the S&P was still below, the 50-day, or even I'm not even sure if it was below a 200-day. I might be exaggerating, but there are a lot of stocks, and also there were stocks that they bottomed a few days ahead of the market, and those ended up being some of the larger leaders.
Well,
So
Nvidia was one that comes to mind. I mean, look at this.
yeah,
The S&P 500 still well below its highs, and at this point, still below the S&P 500 was still below its 200-day moving average line. Whereas
yeah,
Nvidia, that got to highs, very quickly, and actually broke out of this cup with handle, a very nice cup with handle, very early on.
yeah. And even if you look at that very bottom of Nvidia, I'm willing to bet that it was bottomed about 2 days ahead of the market, or 3 days.
Hmm.
And a lot of the leading stocks, they hit that low. I bet you that was probably March 16th. I'm guessing that's when a lot of them
Hmm.
did. Then the S&P and Nasdaq, they hit another new low just a few days later.
Yeah.
You know,
So March 18th was the bottom here for Nvidia. If we look at the S&P 500, the bottom there was March 23rd. So yeah,
yeah,
almost a full week ahead was the bottom there for Nvidia. And again, that it wasn't alone. There were a number of stocks that had exactly that behavior that you were talking. So George, that's on the technical side. What about on the fundamental side? How much are you leaning on your technical analysis versus your fundamental analysis?
well, on the fundamental side, I always start with the fundamentals. We do sometimes drift to other stocks that don't quite have the fundamentals, but I'm more interested in looking at the stocks that have the triple digit earnings, the triple digit revenue growth. They have the institutional accumulation, they have a good up down volume. So I'm always kind of screening for those and looking to see if those are making a move. Those are the most important. And that they usually tend to lead. Now, sometimes in 2020, there were a lot of software names that they didn't have the earnings, but they had revenue growth that was
Mm,
accelerating. So
hmm.
that's another kind of different fundamental. It's not your true pure fundamental where you're getting the 25 or 30% earnings growth that you'd really like to see. But you know that's that's a very important thing. I do play at times stocks that have neither of those, but I'm very skittish. Those are the ones where if I get a 10, 20% gain, I'm out. I'm not going to stick around. But the stocks with the really strong fundamentals, you know, you give them a little bit more room. You give them time. something like Nvidia, not doing that great these days, kind of moving sideways, but you kind of got to give it a little bit of room as long as you're not losing money on it,
Hmm.
because you have a $4 trillion plus company growing at 60 or 80% or whatever it is. That's unheard of. So you have to give that company a lot of consideration in your portfolio.
Yeah.
If you
So
look at, I'm
you know,
sorry,
I
go
just
on.
want to kind of address the patience element here because I've traded Nvidia a couple, well, more than a couple, a number of times, taken a piece here, taken a piece there, but I haven't participated in that big multi triple digit move. And so when I see something like this where the relative strength starts looking very poor, it's very hard for me to sit with something like this because I'm thinking, oh gosh, this is dead money right now, and there's other things that my money might be doing better with, especially in like the current environment where mega caps seem to be struggling a little bit more. I'm just going to pull up FNGS as an example. This has come down to the 200-day moving average line, which is again, this is an ETF of some of your mega caps, what's known as the FANG Plus or the Magnificent Seven. So, yeah, help me out. So, when you're looking at something where the relative strength starts looking really poor, and Nvidia has had long periods where it didn't do much. I mean, this 2024, 2025 period seemed like a very long period where it just didn't have a lot of outperformance. So, what do you do when you know you've got a leading stock and all this cushion, but you don't want to give it all up?
Right. Well, I do trade around the position, meaning,
Hmm.
let's say it goes a 20 or 30% position. I may trim it down, and I might just always keep a 5% position or
Mm.
10%. But even sometimes, if it's really turning down, it's losing the 50-day, I'll get out of it. But if it starts moving above that 50-day, you know, just because they have those really great fundamentals, it's like it's in the back of my mind. If it ever takes off without me, I'd never forgive myself,
Yeah,
So
no.
I do, I do bounce back into it. APP was another sort of similar stock where had superior fundamentals, but was not taken off.
Mm.
That was in probably in 24, and then when it kind of broke out around that $70 area, it just went crazy. But and that was initially, right around that 70, $80 level where the fundamentals were there. The past fundamentals weren't great, but the forward estimates were just off the charts.
Hmm.
And then finally it broke,
Mm.
and then you said, okay, I have to be in this one. I mishandled that one on the way up, by the way, but
Yeah.
that's kind of thing that happens. But that's the one too where after it corrected, then it was showing some bounces. I'd go in there and test it again. I'd try it again because again, it had just those really strong fundamentals. Uh,
Yeah. Well, and I think, this is a good overview of how you handle some of these big winners, but to kind of dive into that a little bit more, and I'm going to go back to, uh, App Lovin', as you mentioned, because this was another one that I played, and it was a little tough because I think I bought the position, but here's where sometimes earnings reports can scare me out, and I think this, I had this right before an earnings report, and it kind of, launched on the earnings report, and then I felt like, oh, I missed it. I got shaken out before the earnings report because I didn't have enough cushion, and then it kind of left the station without me. How do you, since we are amid another earnings season, how do you kind of handle buying positions around the earnings reports? What's your strategy?
well, if I have a position and I have cushion, let's say I have 15, 20% gain in it, I will sit through the earnings report, even
Hmm.
realizing that I could lose it all. I will sit through it. Before I'd kind of trim back, but now I'm like, if we're seeing a lot of good earning jumps, I don't want to miss that. However, if I have no cushion, I can't do it. I have to wait and just see if I can. Let's say it's a good earnings report and we get a gap up and a lot of volume. Then I try to finagle my way into that stock somehow if I think it's really important. So that's what we're waiting for next week. See what kind of earnings reactions we get to a lot of these stocks. But once you get cushion, you sit through those and you can get really rewarded. One of the stocks through 24 and 25, big winners. Actually, the top winner in my portfolio was Palantir.
Hmm.
And a lot of that was because I had that low cost basis and I sat through it. And then I just, you get lucky. Earnings reports, everybody loves it. The hardest thing sitting through that one was that it is the most overvalued on a price to sale company in the history, I think, of the market.
Right.
And so that was sitting in the back of my mind the whole time, you know.
Hmm.
But and if you look at that early 24 when it had the biggest volume ever, even on a weekly chart, and it was the biggest volume ever on a daily chart when it jumped right there. Yeah.
Hmm.
So playing that, and then actually I had to sell out of it a few days later when it turned down, but I never took my eye off the stock. And I had a few kind of like back and forth uh, movement there. But then again, when it broke out past 30, that was like a pile in situation. And then, pretty much held it and through some of the drawdowns, traded in and out of it, you know, uh, in there, took some off, added back in once it reversed higher, and just kind of keep playing that game with that stock. But that's sort of like that's a lot of patience to sit through that, because everyone's like, oh, look at this other new shiny stock that's jumping, or this shiny stock that's jumping. And I was actually shocked Palantir because I thought at $60 it was way overvalued.
Right. Uh,
And it kept going. I'm like, okay, I'm
yeah.
not going to argue with the market.
Hmm.
I'll keep playing it. Now I'm actually completely out of the stock, but that was one of the longer kind of holds of a core position and trading in and around through the corrections. I
Hmm.
think we're right on April 7th low when it hit low on that April 4th, that Friday. I was on IBD Live and we talked about if it made a little undercut, we might have to unload some. And I did actually unload some on April 4th. Yeah, right there.
Hmm.
And then that next Monday, actually, it turned green. And again, we talk about relative strength. The S&P did not, we still weren't trying to follow through day. We were still looking for a bottom, easier to say in hindsight. But I looked at a lot of stocks that turned green that day that had these strong reversals. And I was like, those are the stocks we have to be in. Even though throughout the straight lines quite weren't at highs yet. But again, it's sort of like they were outperforming the market. They were relatively doing much better than the other stocks. You
Hmm.
know, uh,
No, yeah, it's a very good point because I mean we saw some, of course, in March and April of 2025, we saw some very dramatic drops. 50% for some of these high-flying stocks wasn't unusual, and Palantir certainly got close to that 50% drop. So, do you ever have no matter how much cushion you have, do you ever have kind of a line in the sand? Our friend Kathy Donnelly, she talks about the mental capital preservation. Do you come up with a line in the sand to say, okay, as much as I might love this stock, I'm not going to let them take away more than X percent from me?
no, I really don't have that. It's a little bit stock by stock basis. It's a little bit too what's happening in general market. And the reason I say that sometimes we look at back in the stock chart and we'll go like, why did I sell that? It, it was working perfectly well, you know. And in the same situation, we're looking at another stock and I didn't sell some. Well, what's going on? Well, what's going on is you look at like your notes if you keep a daily diary. Something
Hmm.
else was really going on bad in the market, and it was just like, okay, I just want to take some money out of the market because I'm getting hit everywhere else. There's nothing wrong with that particular stock, or vice versa. The stock's not doing that great, but you have other trades that are financing that stock. So
Hmm.
I don't really have a hard and fast rule. I'm familiar with Kathy Donnelly's, and that's really pretty great that she kind of figured it out. I still haven't.
Well, and again, you kind of have to figure out what works for you, right? That's kind of the rule that she comes up with, and again, she has her levels, but everyone kind of has to figure out their own level of how much can you take. I my stomach is not as strong as Kathy's. I couldn't take that kind of drawdown. I mean, she's sat with Nvidia through some 50% plus drawdowns, and um, you know has been okay with that. I could never do that. I just don't have the stomach for it. I want to talk a little bit. You mentioned You mentioned kind of a daily diary. Are there things that you feel like you do? And again, I'm stressing the consistency that you really kind of bring to the table here. You've had some, again, phenomenal results year after year. Um, are there some of these things that you do on a consistent basis that you think really help you, get these superior results?
I really think the most important thing is, and I know it sounds counterintuitive, but it's cutting the losses.
Yep.
If you get into a trade, it's not working, you cut it. And if you don't cut it, what are you telling yourself? You're telling yourself, this is the only idea I'm going to have all year long. I can't come up with any other ideas.
Right.
If that's what you're telling yourself, then maybe shouldn't be doing this, you know?
Hmm.
Uh, but you can just say like, bad idea. Maybe it was the market. Maybe my choice was wrong. Maybe the stock, something or other. But that, I think, is one of the most important things. Now, the other thing is, I think that I've just kind of discovered over the last few years is it was something Bill talked about, and I never really quite understood it, but it's kind of like the big stock principle, meaning
Hmm.
I'm not interested in, although I do at times trade a lot of different stocks, but what is the theme of the current market? And so now it's AI.
Hmm.
In the 90s, it was all internet. And then what are the most liquid leaders in that group? And I really just want to focus on those stocks. And let's say even if I missed it, if it took off, figuring out some way, how can I get in there? Where's the pullback? And I think I've changed a little bit over years because before I was like, oh, this stock's breaking out, although it's in a completely different sector. It has nothing to do with the current theme, and you get a few percent and it reverses on you, and then it's like, oh, another loss. And kind of go and do that. You're like, oh, but it was such a good setup. It
Hmm.
doesn't matter. I think it's really more important that you're zoned in on what the theme is, and it was like the AI, the data center build out and that, so forth. So we're going to see what the theme is this year. I don't know
Right.
yet what
Yeah.
it is. Uh,
Yeah. I mean, the way it started out, it certainly seemed like a lot more broadening out. Certainly, AI plays were not dead by any stretch, but there did seem to be a little bit more of a broadening out with more small cap participation, more international participation. But I guess I would challenge you to kind of walk us through the downside there is that you can potentially get overly concentrated, right? And I just look at a day like DeepSeek, which was January 27th of 2025,
yeah.
where um, you might have felt like you were diversified across different industry groups. Maybe you had a chip maker. Maybe you had something in the energy, like a GEV. Maybe you had something in heavy construction like STR. What is it? STRCL. Stericycle. But these were all AI related. Even the some things that you wouldn't think of, utilities and your HVAC systems. They were all kind of AI related in terms of, yeah, we've got these chips, they run hotter, we need to cool them down, they need all this energy. And so you might have this kind of broad portfolio, but if everything is an AI theme, you can really kind of get hit very hard. So how do you kind of balance that concentration on the theme versus the diversification to kind of protect your portfolio in case you're wrong?
Well, in all honesty, I don't balance it out.
Yeah,
I,
you just push the chips and all in.
I I know. I mean, I do go for it, but I find it easier if you have five stocks that are in that, you do take the hit, but you're
Hmm.
watching more closely and you know where your line in the sand is, you know where you can get out. Because what I found is when I'm owning, let's say 10, 13 stocks, I'm like, okay, you're guessing, you're buying these 2% positions, you're probing, you're testing. That's not a bad thing. You're trying different things out. But where it gets bad is when you got small positions, I tend to give them a little bit more room to the
Yeah.
downside, like it's
Hmm.
not affecting the portfolio.
Hmm.
Then you realize what happens a week later, all these little cuts you're getting in all these smaller positions. It's like one big position and you're taking a bigger hit than you should be.
Hmm.
So I do concentrate and I do, like the larger size positions and I do, you know, I know some people may not be comfortable doing that, but I found that it works a little bit better for me because then you're kind of watching those few eggs in your basket really closely, and then you're you can cut out of them, and you can just go right back in and buy into them.
Yeah, and as you said, when you do get a winner, it makes such a big difference, a much bigger difference when you have a larger position size. It just really can move the portfolio in a big way. But I want to also kind of understand.
Sorry,
Yeah.
can I go one more thing on that theme so we
Uh-huh.
don't get away from
Yeah. No,
so, but
please do.
also, like in 2020, there were times when I had Tesla over 50% position in Tesla.
Hmm.
Okay, but that I'm not being that patient. It had some tremendous moves, those days I was selling into strength. I was reducing that position a lot and then
Hmm.
looking to buy back and a pullback. When you get that big position like that and you have a big move, you have to a little bit take advantage of that and you kind of change it up a little because there were some really big moves there where it just went, 100 points in one day. You're
Right.
like, I better take this gift.
Hmm. But, kind of one of the things you said before was sometimes you're still keeping a piece of it. So were you were you just taking some off the table, or were you completely selling the entire position in those
Uh,
cases?
Mostly I was taking most of it off the table, but there
Yeah.
was I don't remember one, but there was one day where I just sold it all. I go, this is crazy. The stocks, this is
Hmm.
not normal for stocks to move this way, you know.
Hmm.
Uh, so you know, I took it all off and then looked for ways to re-enter the position,
Hmm.
if it comes around again. You know.
This is kind of an important point because I played Tesla too. It was one of my biggest winners in 2020, and I actually played it in 2019 as well. And one of the things I was kind of kicking myself on is I had this really large gain in Tesla, so it became just naturally a larger part of my portfolio. Right? I think I was up to like a maybe a 30% position, but then it went through a correction. I feel like I played it well, and I bought it back. And I bought it back as a normal size position. I bought it back as a 10% position and then had another really great run on it. And I was always kind of thinking, should I have gone with a larger position from the outset? Because I was kind of replaying something that I had a cushion on. What are your thoughts on that? Do you ever, when you go back to something that you had, do you ever kind of consider that previous cushion that you had or that previous profit, or do you just kind of blank slate? I'm treating this as a new trade.
No, I kind of treat it if it's a stock just had a big move. I kind of keep that low cost basis in the back of my mind and say,
Hmm.
I can afford to step right in here at 20% position right off the
Hmm.
bat. I
Yeah.
don't need to test this because I have a huge cushion. Now, that's the stock can reverse on you that day and you lose a little bit more than you normally would in opening up a new trade, but you have to kind of keep things in perspective. Well, hold it. This is my long time winner. If it moves against you, but it's not really broken yet, you can give it a little bit more room until you think like it's broken, meaning, you bought it because maybe it was bouncing off a 50-day average or,
Hmm.
21 day, and then you just said, okay, this stock, if it's going to continue working, it should continue working here. You kind of need to make a little bit of a kind of speculation, not predicting anything, but just speculating what you expect to happen. And
Hmm.
if it doesn't happen, then you can get out. But if it happens, you have that kind of cushion in the back of your mind, and then you can let it run.
Yeah. No, I think of it just in the same way that a scientist creates a hypothesis, right? And then, they take observations to see if their hypothesis is correct or incorrect. And, I kind of look at stocks sometimes in the same way with a scientific method. Like, okay, here's my hypothesis of what I think should happen. And then if the market disagrees with me, okay, well, the market's right. That's what I'm observing. That's the facts. So let me change my hypothesis and come up with a new one. Um,
Yeah,
I also want
totally
to.
agree.
What's that?
I says I totally agree with you.
Yeah. So that kind of brings me to the question I was going to get to is how you start your positions, because you did mention that you are massaging these positions and about how you're adding to them. You might start small and increase it. There's two ways that a position increases naturally through capital appreciation. You get a 100% gain on a stock, it's going to become a larger part of your portfolio, even if you don't add anything. But then if you do add along the way, you can be very strategic about that. So, what is your approach in that regard to get more money into the stocks that you identify as leaders, and especially when your hypothesis is proven right?
Okay, so for me, it matters where you are in the cycle. So
Hmm.
meaning in 23, we're kind of coming off the 22 bottom, but it was still a pretty scary time, October 22nd in the market. So all the new buys I was doing, and this kind of, worked against me in 23. I didn't have great returns. I had a positive return, I don't know, 10, 15%. The market did
Hmm.
a little bit better because I was just testing stuff because, 22 was kind of pretty brutal bear
Yeah.
market. So all those buys were small. There was no way I was going to step into something right off the bat, 10, 20%. It was all like 2, 5%. You're
Hmm.
probing it, you're testing it. And that's the way I usually do it. Now, once the markets ran, and let's say I've done very well, and it's run for another year. So now I will step in, 10%. That's almost like your starting position. At times, 5% if it's like a new stock, I'm not familiar with the way it trades. But and then the second it's working for me, I'm trying to get that up pretty quick to 20%. Now, however, let's say it's a stock I'm not that familiar with. I try 5% position and it takes off. Okay, I'm not going to chase because I'm always concerned about where's going to be my average cost and where could the stock pull back to. If it pulls back to the 21 day, that would be normal. But if I added too much, if I, you know, let's say I bought a 5%, added another 5 and another 5. So I've got 15%, fairly large position, but my average cost is maybe above the 21-day line. That's a bad trade. That I didn't think about that very well because stock pulling back to the 21-day, that can happen anytime. It's not a broken trade. The stock's in a trend, but you're giving up all your money. So it's kind of trying to measure all that. Where's your average cost after your first buy? So
Hmm.
after the market's running and say I've done well 2 years in a row, so now I'm buying stocks that I know it's 10% right off the bat, probably moves up a little bit, 15%. Now, again, if it starts running away before I had a chance to build up that position, I can't just chase it. I have to find out where my average cost is going to be, what's normal to pull back. Does the stock normally pull back to the 50-day and then bounce? So if that 50-day area is going to be below my average cost, I can't build up that position too much. So it's everything's a little bit of a kind of game. And also too, let's say the stock, we'll use a scenario, let's say there's a flat base and it's kind of just big move up at 50 days. So you're really close to where you think the line is in the sand. You can go for a
Hmm.
larger position. But let's say a stock broke out. It's still kind of in a pivotal buy zone, but it's kind of off the lows, a distance away from that 50-day. Well, then you can't go in with a big position just because of that, because there's a pretty good chance it can pull back. And if it pulls back, it could be extreme. And then, I try to make it that no one trade will ever be more than a 1% hit to my portfolio.
Yeah.
Uh, Kind of pretty much the way I structure everything. And if I look through all the years, let's say I trade 100 stock that year, 50% were winners, 50% were losers, and there was like 6 stocks that make the whole year and everything else was a waste of time.
Yeah, yeah, and that's very normal, by the way. I studied Bill's portfolio, the founder of Investors Business Daily, Bill O'Neill, that you referred to earlier. And
Yeah.
I've looked at some of the, even the IBD 50 performance of the IBD 50. I've looked at a lot of different things, and I would say, just a number off the top of my head, 8 to 10% is what I usually come up with. 8 to 10% of the performance, is it comes from 8 to 10% of the stocks. That's where it's at. And so, as you said, that's why the risk management becomes even more important, because you have to make sure that you're keeping, those 50% losses, 50% of your trades that are losses. As long as you keep them small, it allows those 8 to 10% winners, really big winners, to make a bigger impact. So.
Yeah. And I'm pretty good at that. If anything, I kind of get a heat map at the end of the year. If anything ended up being more than a 1% loss of portfolio, it's probably because I tried that stock 3 or 4 different
Yeah.
times. It didn't work either time.
Right. Yeah.
You know?
Yeah. You took a number of 1% hits to your portfolio from the stock, maybe. So yeah,
Yeah.
no, I've been there, done that. I think yeah, this last quarter I had a few of those that I kept on trying, and it just didn't work out for me. And to that end, I was we were having a conversation about kind of the lumpiness sometimes of your returns in a year. Where a lot of times people think, oh wow, a triple digit gain, you must have just been doing so well throughout the year, but I don't see I don't think I've ever seen my equity curve do that. It goes up, it comes down, it goes up, it comes down. It can have some it can have quite a bit of movement, or sometimes it's not doing anything. And we talked about 2024. 2024 wasn't a great year for me until October, November, and all of a sudden I had like a 25, 30% month, 1 month, and oh, okay, now I've got a good year. So, how do you kind of handle that when you're looking in your portfolio, and sometimes that frustration of having the money and then seeing it going away? And is there anything that you do to kind of smooth your equity curve?
Um, well, what I do is kind of more like smoothing my psychological curve. You know,
Yeah, that's even more important sometimes.
yeah, because like you were saying, 2024, everyone's talking about a great year it is. The first 8 months, 9 months of the year for me were it was typical, like, oh, mid-month, I'm up
Mhm.
10%, end of the month, zero. Oh, mid-month, I'm up 20%, end of the month, zero. And it was just like, and I'm like, what am I doing wrong? And I look, I'm not doing anything wrong. Meaning the stocks are acting funky. I'm cutting my losses. I'm not letting anything blow up on me. I'm just maintaining my money. So I was just like, just stick with the process. It will work as long as you just keep cutting losses. You have money to keep trying things. It will work. And then voila, come September, the market, especially in the growth stocks, just exploded to the upside for me. I mean, coming in September, I was basically at zero, and then by by Christmas Eve, I was at 120%.
Hmm.
And then it came off a few days, so I ended up at right below 100%. But that's just sort of being patient and staying with it, and just not deviating, not having FOMO and chasing some crazy meme stocks or something like that. Just sticking to your process. And I knew, like, this works. It comes around when the market's right. You're gonna do it fine, and that's kind of how I deal with that.
Hmm. So in that end, again, there were a lot of stocks that were very volatile in this 2025. Oklo, for instance. Got to do a O instead of a zero. Very very dramatic moves. Bloom Energy. Do you have a limit in terms of some of these stocks? Again, Oklo didn't have any earnings, but there were certainly some of these stocks that had very wide swings day to day. Do you ever kind of say, oh, you know what, this is too much? Do you have like limitations on yourself based on the volatility a stock might have? Certainly if you have a lot of high octane stocks in your portfolio, and they all go against you at once, it can be a lot more than a 1% hit to your portfolio. So what do you do with some of these high octane stocks? Do you just skip them
I
or manage them with smaller positions? Or
uh, I might get a large position in them if they really start working, but I will only have one or two max at a time in the portfolio. You
Mhm.
know, because if we look at May, when like CoreWeave went crazy, and then I think in June Circle went
Mhm.
crazy. You know, I was in those uh, kind of at the same time. I'm like, whoa, that's it. And then Aklo was going crazy at that time too. I think he had a pretty big jump. Then I
Mhm.
think those. I go, well, I can't. The portfolio can't have all these kind of. Yeah, so maybe it wasn't. Yeah, that's actually a pretty good move there around that $70 area. So I can't have too many of these,
Mhm.
but I will put them on now. CoreWeave, which that was kind of like a lucky IPO base. I didn't really think so. And then I'm like, oh my God, this thing's working. So then I did kind of pile into it. But again, keeping in mind where my average cost was. Uh, so it's, you can't have too many of those in your portfolio, but
Right.
those can really give you some returns. I mean, if you look at Circle, CRCL, that's a funny story on this one. I'll tell you what. I had a buddy that was buying on the IPO day, and I
Mm-hmm.
thought he's pretty, what's he
Mm-hmm.
doing here?
Mm-hmm.
But anyways, it when it went back over 100 and it pulled back and it was bouncing off 100, in my mind I said, okay, here's the play. I'm just going to use that 100 kind of. I kept waiting every day. Is it going to touch 100? And it wasn't. I like, okay, so I'm just going to, buy a little bit here, and I just bought a little bit 5% position, you know, about 103, 104, and then the thing just took off. Yeah,
Mm-hmm.
I didn't get the position, didn't get any larger, but the stock tripled. uh, so, and then
Yeah.
once it
So
reversed
it
off
became
300,
larger on its own
yeah,
without you doing anything. Um, well, and again, sometimes when you see these high flyers, they can come down just as dramatically. So again, you talked about when something's kind of going crazy like that, that you take some off the table. So maybe walk us through like that part of it. What was kind of your sell rules once you saw this go up so dramatically in such a short period of time?
well, I kind of have the century marks sell rules. So meaning
Hmm.
when it ran to 200, I'm like, okay, maybe I should sell it. Now it's just like, maybe I'll give it one more day. It's only 5% position. You can give it a little bit more room. And then when it ran to 300, I was like, okay, you're really pressing it here.
Hmm.
Take the money and run. If we go back to CoreWeave, I think that could be a little bit better example because I kind of remember this trade a little bit more. So, it got over $50. It was kind of making that IPO U-turn and about a little
Hmm.
bit over $60. So I was starting to add right after, as it was breaking out. I was adding to there. Now, right as it crossed the 100, I almost sold. I was like, okay, it just doubled in no time on you. So that's kind of a sell rule. I'm like, okay, if it closes below 100, I'll sell it. If it doesn't close above 100, I'm going to hang on to it. And then it just, had some intraday moves back below 100, but then it held it and then it went higher. So I'm like, okay, I'm going to add just a little bit more. And then once it got, that 187, once it got close to 200, I'm like, you're really pushing it. You just, this isn't normal market action.
Right.
Maybe just for Sandus these days, but you know,
Yeah. Uh-huh. Uh,
this isn't normal market action. You gotta, thank the market gods for giving you this
mhm.
and get out.
Hmm. Well, and I guess again, it sounds like you kind of get a feel for things of like what's normal, what's abnormal, and certainly I think for a lot of people, you get a move like this, and it's hard not to be greedy, right? It's not hard not to contain that emotion of greed, where you start thinking, oh. It's gone up 100% in a couple weeks. If I just wait another couple weeks and it does that again, how much money I'm going to be making, and it's hard not to see stars in your eyes of, all the possibilities. So is there something that you do to kind of keep your emotions in check in that way?
Well, I think it's just knowing a little bit of, market history, that knowing that this is abnormal behavior, and I know like some of the younger traders I'll talk to, they're like, oh, why is it going down? I'm like, the question should be, why did it go up so much? What happened? That was the abnormal part.
No one
Reversing off,
asks that question, right? It's just like you think it's because you're brilliant and you're stock picking. That's it's
yeah,
all because of you and how awesome you are.
yeah, the abnormal move was to the upside. You're going, wow, what happened here? That's abnormal. The reversal's more normal. And I think just kind of keep that in mind. It's always a little harder with newer stocks we're not familiar with. Uh, but each stock has its characteristics. Like I look at stock like AMD. You
Hmm.
know, I've traded that stock since about 2015. And one thing I know is like it loves to move off the bottoms, but when it scales up to the tops, it reverses really hard on you as well. So you just know that that's the character of AMD, and then when it plugs along the bottom, even though the story's great, the fundamentals great, the earnings and sales, and it's not doing anything. But once it moves off the bottoms, it moves and it moves quickly, but then it
Hmm.
comes back pretty quick too. So it's knowing. the history of the stock, and each stock has a little bit of a characteristic like that.
Hmm. And I mean, certainly you've got a number of years of experience under your belt, but when you aren't familiar with a stock, what do you do to kind of understand that personality? Like, let's say you hadn't traded AMD back in 2015, and it was kind of new on your radar. Uh, uh, are you looking at just multiple time frames? Are you doing a deep dive into how the earnings were, or again, how do you kind of learn that personality? Or is
Well,
it just
I
something you
look
get from
for,
trading it?
well, you get that look from trading it, but then I also look at the longer term history. There's a lot of stocks that just have explosive moves on earnings, but then they go sideways. Next earnings comes along, they explode up and then go sideways. And I hate those kind of stocks. I think you and Chris Gessel had coined the term stair steppers,
Yeah, right.
and
Yeah.
yeah, I hate those kind of stocks. But so so I kind of generally avoid those stocks.
Hmm.
So I just try to look at the history of the stock. When does it move? How does it move? And that's really all you can do. And if the stock doesn't have a history, it's really kind of difficult.
Hmm.
Uh, the hardest thing is trying to keep away your personal biases. Like something like SanDisk when it had its first breakout move this year. I'm
Hmm.
like, oh, SanDisk, that's like a 90s stock storage. Well, it's like a peripheral thing, doesn't really, that's not important, and
Hmm.
just missed the whole move. Uh, but it had the rule, if you look at that 10.2 million, I think that was the big breakout day there in September,
Hmm.
uh, that big volume, that was your tip off, and I'll look at that for every other stock I buy. But this one, to my detriment, I ignored. And
Hmm.
then I had to find other ways to get into it further down the road.
Yeah, no, and look, it wasn't easy because again, this was something that didn't necessarily have the fundamentals. I mean, it had the story. Again, that becomes a little bit more obvious later, and I'm just gonna change it so that you can see a different scale here. Actually, I'm gonna go back even further because even that is gets kind of squished. But
Yeah.
yeah, there's your there's your big move in September that kind of started this, and it just kept on going from there. Um, yeah, pretty amazing move. So you kind of mentioned this at the forefront, and so maybe this is where we can end as well. You talked about kind of identifying that theme, and certainly, one of the themes has been the memory stocks, like SanDisk and MU, Micron, and WDC, STK. I do have a position in STK right now, but not STK, excuse me, S
That's good.
Seagate, Seagate technology. There, I was like, that doesn't look right. So, have you started to kind of identify a new theme, or are you thinking that maybe it's kind of back to the old theme, that the AI theme is still not dead here?
Uh, I'm still on the AI theme. I'm looking, but I still haven't discovered what the new theme is. I mean, I still
Mm.
think it's an AI theme. The only thing in the back of my mind, what I have going on now is so uh, this year it's all been small caps and mid caps, and they've
Yeah.
been leading. But it's
Hmm.
really hard to find a great liquid small cap stock where you can like put a lot of money into it because they tend to be low priced and it, it, they're just very hard to move money through. So, but what's in the back of my mind is all these Mag 7 stocks, look terrible.
Mm.
Now, every mutual fund, the big Fidelities, the T. Rowe Price, the Lord Abbett, Morgan Stanley funds, they still make up 40% of their portfolio.
Yeah.
So somehow I'm thinking these guys, they can't have two mediocre years in a row.
Hmm.
They're going to juice these stocks somehow. Now, this might be a crazy theory up by me, but this is what's been going through my mind the last few days, not to discount these stocks because they're not broken. They're making money. They're not over expensive. They have more
Right.
money than all the other companies in the world.
Yeah.
So I'm kind of just looking at, you know, now the same stocks never lead through many cycles, but this is like really, they're still the stocks that are making the most money and
Yeah.
have the most money to do whatever is going to be the hot thing going forward.
Hmm.
So that's just something I keep in the back of my mind. But And if I ever discover what the new new theme is, I'll let you know. But if you discover,
Awesome.
you got to.
Yeah, George, you got my number. You give me a call.
Yeah.
Speaking of which, is there anything? Do you post up out there, or where can folks find out more about what is on your mind on a regular basis?
I put out a weekly newsletter that I
Hmm.
send out to friends and other people I know. So, they send me an email, I'll put them on the list. And it's just basically, just what stocks I'm looking at, what I think could possibly be working in this market and so forth. It's a fairly short thing, just sort of the stocks I'm interested in.
Oh, very good. Well, George, I really appreciate you coming on the show again. Again, congratulations on a number of really strong performances on the U.S. Investing Championship. That 1 million plus money manager division. You've really like a poker player that keeps on making it to the final table. I feel like you're one of those guys we always see on the leaderboard there for the U.S. Investing Championship. So congratulations on that.
Well, thank you very much. Thank you. It's
Okay. Nice
very
talking
kind.
to you again. So, again, George Tkaczuk from RCM Wealth Advisors. And next week, hope you join us for that because on February 4th, we're going to have Matt Caruso from Caruso Insights back on the show. Always great talking to him, great educator. I call him the professor because he used to be a professor, teaching finance at college for a while. And I feel like he approaches the stock market in the same way. So, looking forward to have Matt back on the show. Hope you join us for that. Take care, everybody, and have a good one.